Your money, your business. This is Financial Poise Radio, the spoken word sister of financialpoise.com.
Hello, everyone, and welcome to Financial Poise Radio. I am your host, Christopher Cahill. In a few minutes, I'll be speaking with Jorge Newbery, also known as Jorge Newbery, founder and chief executive officer of American Homeowners Preservation. And the name of the entity is very significant as regards its purpose. Now, how do you give current owners of distressed properties in less advantaged neighborhoods the opportunity to pay far less per month on their mortgages than they have been paying? Maybe they took out equity financing off their mortgages. Maybe they've had problems in their employment or other obligations they've had that limited their ability to pay mortgage interest and mortgage principal in the past, which has caused their obligations to multiply. And now they cannot get even with the bank. So let's say the bank is charging 10, but the people inside the house can't pay 10. They can pay 3. There is a solution, at least according to Mr. Newbery, a way to relieve those current owners of the need to pay 10, and a way of relieving the lenders of residential mortgages that don't look like they can be performed by the current occupants, but which cost a great deal to foreclose upon, and then a great deal to sell or to hold. So in this sometimes miserable conjunction of factors, Mr. Newbery has created an enterprise which not only can help the parties involved, but can attract investment because the enterprise does run a profit. I invite you to listen to him in a few minutes. First, let's talk about blockchain. It's something we've talked about many times on this show. I hope that the people listening will take the time to look for clear presentations about blockchain. It's manifesting itself in various places, including on this show, well, indirectly on this show. A prior guest, multiple guest, is named Scott Picken. He founded a company called Wealth Migrate. So while Jorge Newbery's enterprise does well by doing good in solving a particular problem with regard to certain kinds of mortgages in certain places, Scott Picken's enterprise, Wealth Migrate, solves a different problem. Scott Picken is from South Africa. Up until about 10 years ago, South Africa was on a trajectory toward very responsible management of its economy. But in the period since then, under President Zuma, the place has become more and more politicized thoroughly, and capital is at risk, and capital would like to flee. And sensing that and wishing to facilitate the preservation of wealth for those who have built it up, Mr. Picken founded Wealth Migrate to help investors in South Africa invest in places like Australia, the United States, and Great Britain in real estate in these places. These are rule of law countries where what you buy today will still exist tomorrow and not be taken away by the political powers that be at a given time. Compared to other countries, that's certainly true. And Mr. Picken expanded his horizons to provide a means for people in any country to buy real property in many other countries, not all other countries, and has received some traction, for example, in China, where there are people who wish to deploy capital outside of China if they can evade the currency controls, and people in countries like the United States who simply wish to invest cross-border in real estate. Well, we're taking the long way around. What the innovation at Wealth Migrate is to apply blockchain to their administrative processes, what they describe as an additional level of security and peace of mind, with the ability to have an uneditable record of investment, providing transparency in the process. Again, please read about blockchain because it's coming and it's going to be important. Maybe not changing the world the way people think, but important. It's a distributed ledger, meaning that multiple parties can take part in this essentially online ledger. Multiple parties can take part and they can enter data into the ledger, but none can change the data. It is permanent. It can't be changed by anyone. That's its basic value proposition, is it's reliable and transparent. And they load it up with other security things like encryption to keep parties outside of the magic circle from doing anything to the ledger. And Wealth Migrate is leading the field of online real estate investment portals in adopting that technology to real property. So we have two real property innovators on the program to come and on programs past. Another word about blockchain. We've spoken in the past about one of my favorite topics, which is the use of blockchain to support land title systems in countries where land title has been not very secure. Remember what I just said about blockchain as a distributed ledger system in which people can add in data, but the data cannot be edited. That is precisely what one would want in a land title system if one is seeking to have honest transfers of title recorded. This is precisely what was not wanted in comprador elite countries and countries where elites trampled on the rights of the many and prevented people from having truly defensible land title. So there are efforts in Honduras, there are efforts in Georgia, the Republic of Georgia, that is, not the state of Georgia, to use blockchain to create incorruptible land title regimes, land title systems. The very fine economist Hernando de Soto has been inspirational because of his own work in the key role played by incorruptible land title systems in the broadening of economic development within a given country. Now, the development there is that on February 7, 2017, the Republic of Georgia committed in a signing ceremony in Tbilisi to use blockchain to validate property-related government transactions. That is a first step to what is intended to be a comprehensive solution to land title system in a former Soviet bloc communist country where land title was, to say the least, highly politicized and totally insecure. I received a kind of surprise in reading the article. And by the way, this is from Forbes magazine, February 7, 2017. The author of the article is Laura Shin. And the surprise for me is I live in Chicago, in Cook County, Illinois, and allegedly software is being created not just in Honduras and Georgia, but also in Sweden and Cook County, Illinois, to help with land title registration system. You'd think in a market economy and rule of law country, we wouldn't really need it. But my thoughts as a longtime Chicagoan drift back a quarter century to when the land title system in Cook County was placed in some kind of peril. You see, there's a Chicago River heading through town. And while the Chicago River did not go over its banks, there was a puncture in the wall of the Chicago River, which led into some small tunnels, not big enough for trains, but big enough for smaller rail conveyances that were routed throughout the Loop area in downtown Chicago, underneath many buildings, most people not at all aware that they even existed. However, they were designed to be portals to sub basements of older buildings, one of them being the City County building, made famous in the film Blues Brothers. That's where the film culminates and ends when the Penguins building is saved from being sold for taxes by the great efforts of Julia Jake and everybody else. Anyway, that building, its sub basement was where the land records were, and they were subjected to flood damage in that crazy little apocalypse beneath the streets of Chicago. So you never know where insecurity will come from. And it's a winner to attempt to innovate in the area of documentary security. That seems to be the message of the brief history of blockchain. Enough of me. Let's get to Jorge Newbery. So we're here with Jorge Newbery of American Homeowner Preservation, LLC. But George, you and I are acquainted from a conference, which we'll mention a little bit more about later. So I can imagine what your inspiration for starting AHP was, now that I've known you a little bit. I imagine that your inspiration for starting AHP and its predecessor was to force a conversation between the lender or servicer and borrower. Borrowers are not good at asking, and lenders or servicers have one script sometimes, and that script is no. This dynamic is particularly strong where the borrowers have less means and financial sophistication and maybe took out subprime loans and have fallen behind, and the value of the residence is now less than the outstanding balance on the loan. Before I go on any further, George, does my surmise fit your reality?
It does, to a large extent. I'll tell you the trigger that I myself, about 10, 12 years ago, owned 4,000 apartment units across the country, and one of my buildings, my biggest holding, 1,100 units, was hit by an ice storm, and it triggered this series of events which, over 18 months, went from having a net worth of tens of millions to losing everything and being $26 million in debt. And I saw how my creditors approached me, and the ones that were very difficult and, hey, we're going to push. Many times I started pushing back because I just didn't have the money to pay them, or I'd shut down. And I saw that. So eventually, as I recovered, I rebuilt myself through this company, American Homeowner Preservation. And in doing that, we approach borrowers the way I would like to have been approached, which wasn't very common, which is, hey, here's a solution, or here are some options that we can offer, and some real numbers, not starting really high and then working your way down. This is what we can do that still is profitable for us as a debt buyer, American Homeowner Preservation, and also should make a lot of sense for you as the homeowner. So I think we're saying yes from the word go, and you're right, a lot of the lenders are just no, or maybe we can do something but send us a whole bunch of paperwork, tax returns, bank statements, and all this different stuff. And that creates a long marathon for many of these homeowners, and usually at the end of the marathon, most of them end up not getting anything, so it becomes kind of frustrating for them to even get started when a new lender comes along.
Okay, so you try to make that into a real conversation, having your experience of dealing with lenders who will write down debts, who will strike a deal rather than lose everything on the particular loan. You're finding this conversation just isn't happening, especially with people without your sophistication and background. So you tried a nonprofit solution at first, which I found really interesting, before you hit upon what you've hit upon with AHP. Could you talk a little bit about how the nonprofit solution worked out?
Yeah, the initial thought was that we would issue tax-exempt bonds. So a nonprofit made a lot of sense, and I'd done some tax-exempt bonds in my prior career developing low-income housing, and that was the thought. And it made sense that this is a nonprofit, public benefit corporation to buy. At that point, we were simply buying the homes from families on short sales and allowing the families to stay with a lease and then an option to repurchase at just a modest amount more than what we had purchased for the home. And what worked is, let's say a family owed $100 and the home was now only worth $50, we could drop their monthly payment and then also give them the option to buy it back at $55,000, some modest increase, and it still made sense financially for the nonprofit, and made a ton of sense for the homeowners. But what happened is we had literally thousands and thousands of families coming to us for help because it made sense. But then we had an extraordinary time getting lenders and servicers to agree to approve these transactions. Sometimes they would even say that the price, okay, we think this is a fair price, we'll approve it, but we're adding a requirement to the approval that the family has to move out of the house. It was almost illogical. They were getting the money that they thought was fair and they agreed was fair, but they were requiring that the family moved out of the house, which kind of nullified our whole purpose. And even the biggest banks, Wells Fargo, Bank of America, Ocwen, as a largest servicer, and HUD, Fannie Mae, Freddie Mac, they all had these restrictions, and we would get exceptions once in a while, particularly when the media got involved, and they would almost shame the lender into approving it. But those were exceptions, and the vast majority were just denial. And so as we started this company, we kind of took what we learned from those experiences, and we'd sometimes find ourselves asking, well, what would Bank of America do in this case? knowing that answer, we would then say we want to do the exact opposite, and that's usually what we do at American Homeowner Preservation right now.
Okay. So, yeah, you tried to reason with them.
We do.
You might even say the bank personnel you're dealing with, and I guess it's not really always banks, is it? Are there other sorts of lenders besides banks, or was it all banks?
No, banks, hedge funds, all kinds of different investors.
Who's ever holding the note and the mortgage, and they have this script. But even when you're able to break through and come up with a formula that gives them the monetary resolution the lender needs, feels it can live with, as opposed to foreclosing and so on, which costs money and time. Even when you get there, they still have these weird requirements, weird to us. Sometimes I think lenders get emotional about these things. They need something more than just the deal. These people didn't pay their mortgage, so they have to go. So you put yourself in the driver's seat, you might say, didn't you? You became a hedge fund yourself, buying loans. Why did you do that?
Yeah, exactly. We did it because then we're in control. We had homeowners who were begging for deals, and we had investors begging to participate. I mean, everybody was interested except in the middle, the bank or the servicer or the lender, hedge fund who was just saying no. So we needed to take that obstruction in the middle out of the equation. And once we did that, now we can make the decision. So we can buy these loans from Citibank, and we can go to the homeowner and say, hey, we just purchased your mortgage. Here's what we can do. We can do if you want to stay, here's a modification. Here in that initial letter to the family, we're giving them their new payment, their new principal. We're telling them, you haven't paid in 3 years, so you owe $25,000, but give us $2,000 and we'll forgive the difference, which almost sounds charitable, like we're a nonprofit, but the numbers all generate a good profit to us and a good return to our investors. And so we make it very simple, and our goal is to, in every situation when you can achieve a fast, consensual solution without spending any legal fees, whether it's a mod or a short sale or deed in lieu or settlement, all those resolutions will always generate a greater return than going through a long-term foreclosure process, fighting the homeowner, spending legal fees. That's really doesn't work very well. And people have bought these, there are other funds that have sprung up to buy these loans, and then they say, okay, well, we want to foreclose on everybody and then turn these into REO or rental. And the problem is you can't mandate a solution on a family. The family's there. They want to stay. So it's going to be really costly to turn that into REO or rental. If they get attorney and start fighting back, then you're both feeding attorney's fees, and it's going on a long term, and you're not going to have that happy of an outcome. So here, if they don't want the home, sure, we'll give you cash for a deed in lieu, and that's done. But if you want the home, that's great too. So it's really the borrower gets to choose the solution they want, and all of them are still profitable for us.
All right, let's take a little detour then, because for the form you've used for your new LLP, by contrast to the nonprofit solution, is a hedge fund. So you're a hedge fund, and hedge fund is associated in the popular mind with people in fancy suits making lots of money they don't deserve, or, making lots of money, and I'd like to do that too. And maybe even some people say hedge funds are the face of the 1%. But you're a hedge fund, but explain please how you compensate your investors.
So we pay our investors the first 12% of the returns that we generate. And historically, we've generated returns in the 20s and 30s. So we've generated very strong returns. So there's more than enough money to pay the investors 12% and still be viable as a business. But I do agree with your observation that many people in America today correctly view hedge funds as the cause of much of the financial distress in this country, and also the face of the 1%. And that was always a challenge. It kind of was a little bit painful to be taking. For many years we could only accept monies from accredited investors, which are basically the wealthiest 3 or 4% of the population in our country, and then we can use that money to help everyone else. But what we did recently was the SEC unveiled a program which allowed us to apply and go through a qualification process in which we can now accept investments from accredited investors, just like we always have, as well as non-accredited investors. And for me, it's like investment justice. There's actually anyone can participate, and you can invest. An institution can invest millions of dollars. A high net worth investor could invest $500,000, and a non-accredited investor can invest $100, and they all get the same terms. They're all getting the same returns, which is for me, feels right. And it is a lot more work to work with the $100, $500, $1,000 investors. But using technology, it's actually something that we're able to do, and we think we'll become more and more efficient at it. And it really creates investment parity. It's something we're not the only company. We're the 16th company in the country to start raising money under this. It's Regulation A+, but it's still very, very new. But we can raise up to $50 million, so it really gives us a great deal of flexibility. So we're really excited about that.
Well, I should mention here that Financial Poise, which is the host of this program, also hosts a site called Crowdfunding. On that site, you can find out pretty much everything you need to know about Regulation A+, about Title III of the Jobs Act of 2012, to which George was referring, which allows for crowdfunding of equity in private companies if certain rules are followed by ordinary people. A+ is another route to crowdfunding of equity, that is ownership interests in business entities under the Jobs Act. But just two different ways of doing it. And if you wish to learn more about that, please go there or look at our crowdfunding webinar series on Financial Poise webinars. We have new ones and we have old ones. Well, all right. So you might actually be making some money from this, right, George? Yourself as or AHP as a general partner might actually be doing good by doing well.
Yeah, HP does okay, and I get a salary, and we have several employees here. It's a viable business. We've been in business. Yeah. Counting the nonprofit, we've been in existence for 8 years, and the business has evolved. But I think this is a great time for us. We've learned a lot along the way, and we've used those lessons into what we're doing now, which is buying these loans. What's exciting is we can generate these great returns, and sometimes, especially socially conscious investors say, well, why are the returns so high that, it seems wrong, almost like we're doing it off the backs of the homeowners. But the reality is all these returns are generated at the time we buy the loans. If we can buy these loans cheap, which we do, then whatever resolutions we have are going to generate returns, in the 20s and 30s in most cases, provided things are, that's what they generate. I was trying to add a caveat, my attorneys always say, what is it? Past performance does not necessarily mean what the future returns will be. I forget exactly what it says. So historically what we've done is we bought these loans really cheap, and by buying them cheap, and if someone owes $100,000 on a home that's only worth $50,000, I can probably buy that loan for between 15, 20, in the low 20s. So I can buy it less than half the current value of the property and less than 25% of what's owed. So by buying it so cheap, we have huge flexibility to generate good returns and also do social good.
So you're also cutting short that conversation we talked about at the head. Now, because you're a loan buyer as opposed to the homeowner who's failing to live up to the homeowner's promises when it entered into the loan transaction, now you're talking with a bank or a lender that's clearly weighing the costs of foreclosure and the likely return from a sale at foreclosure and saying, all right, give us $20,000 and you're fine. So you've changed the conversation by eliminating one of the participants at a price that fits their needs. And now you've bought yourself some running room for dealing with the homeowner himself or herself. I guess that's kind of the outline of it. So let's just do a few scenarios. I know we've already alluded to it, but somebody in 2008 who was of modest means and a modest background begins to think, you know what, maybe I should own a home. Home values are going up. Maybe I should buy one here in my neighborhood. And then what happens?
They took out a loan of $100,000 on a home which they probably paid $100,000 for. So unfortunately, the loan programs at that time were very easy for people to get credit, which I guess is good and bad. The bad news is because of that ease of credit, that really pumped home values up a great deal. And so that appreciation, kind of like any pyramid scheme, all the people who sell along the way generally make money, and then the last people in who buy it at the peak of the market, in this case with 90, 95, 100%, or sometimes even more than 100% financing, now they're left. And now the market collapses in 2008 and 9, 10. And now all of a sudden those home values, where they bought it for 100 and it was worth 100, or they refinanced up to 100, now the home value is only worth 50. And even worse, now there is no financing, or the financing is very restrictive, which has even compressed prices, made prices continue to fall in many of these neighborhoods. So it was 50 and now it's 40. And now family still owes 100. What can they do? And they apply to their lender, and they want a modification, and they're asked to provide tax returns, bank statements, a whole bunch of documentation, and maybe they've lost their job, or they've had a gap in income, they've had a divorce, they've had medical bills, any other reason. Now they're slipping behind, the modification isn't approved, and they're in these homes. And they're still, this was acute in 2008 for almost all price levels, even the higher income, middle and higher income families. But as it's gone on, there's been some appreciation in in the suburban neighborhoods and some of the higher value neighborhoods, which has taken people from underwater back to above water. But these low income neighborhoods have shown very little, in some cases no signs of recovery, and those values have stayed stagnant at kind of this low number or even dropped. And as a result, some of these families are just there. They owe 100, the home's worth 50, they can't afford to pay it, they want to make partial payments, they want to do a mod. Their lender's just saying no, 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 and so eventually the loan gets sold, and it gets sold ideally to us. And now we're, hey, yes, whatever you want to do, and it works well.
George, before we get to the point where it gets sold to you, there was a federal response, the HAMP program, the HAMP program. Did that work out as it could have? Did that work out as expected? Why is a year still needed if we had this federal response?
Well-intentioned, potentially well-intentioned, but it ended up assuming that this is a temporary problem, and so we're going to use federal TARP money in many cases to bring these homeowners current and give them a modification with a short term, a 5-year reduction in their interest rate. So presumably over 5 years, everything gets back to normal. And at the end of 5 years, they can go back to paying their regular payment. And at that point, maybe no one really knew it would get as bad as it did. So now, actually at this point, a lot of those 5 years, a lot of those families have gone the full 5 years, and now the loans are going back to their old payment amounts, and they can't afford them. And they still, a big challenge with HAMP is the vast majority of HAMP modifications did not include principal reductions. So the family owes 100 on the home worth 50 5 years ago. Now that home is worth 50. If they're lucky, it may well be worth 40. And so they still owe 100. What's the motivation to keep paying? From a business perspective, there's no motivation. From an emotional perspective, sometimes there is a motivation. But it really wasn't a cure-all. And what happened is the money ended up, in most cases, going to the lenders, and in some respects, bailing out the lenders. And, it went through the homeowners, on behalf of the homeowners, but it really didn't. It really would have been better at that point if the lenders had to write down their mortgages and reckon with the problem then, as opposed to kind of kick the problem down the road 5 years, and which means there's still millions and millions of these loans to families who just can't afford to pay them.
Looking back 5 years or 8 years, as the stress started to build in various parts of the economy, there were lots of actors who did believe it would snap back, or in denial as to a more longer-term change in growth rates within certain industries. And I imagine the lack of long-term snapback growth rates really hit the homes that you're describing. So that this 5-year program ended up just being a temporary subsidy for the banks, really, and not a significant, meaningful help for the borrowers. So now you step in, AHP steps in, and now owns the loan, and gives the offers, and the offer is received and taken and accepted. You're going to slash the $100,000 principal to $50,000, and you're going to slash the interest rate to 1%. Much better payments every month for the borrower. You make your money, the borrower gets relief. Okay, but I'm not a tax lawyer, but I understand that when debts are forgiven, it is treated sometimes under the tax code as income, which sounds like a pretty hefty tax bill potentially to a borrower under this scenario. Do you have any thoughts about that?
Yes, what you're referring to is a 1099-C cancellation of debt. And you're right, it can be generated as a result of any of these resolutions, a short sale, a modification with a principal reduction, a situation where even a homeowner is foreclosed and the lender sells it for less money. So many of these families are destined to get 1099-Cs in most cases. However, the good news or bad news, however you look at it, is the vast majority of our population is insolvent, which means that they were to line up, list all their assets and all their liabilities on the day of that modification, on the day of the short sale, whatever resolution they have, and if their liabilities are greater than their assets, then the IRS provides that no tax is due on that 1099-C cancellation of debt. And that's the case. Many homeowners have that apprehension, what's going to happen if I do a principal reduction, if I do a short sale, but there's many, the vast majority of families, 76% of our country live paycheck to paycheck, and just under 50% spend more than they make. And so those numbers, in this case, it's actually advantageous. It's unfortunate, but it's advantageous in this case.
I see, yeah. Okay, well, let's look at aggregate outcomes. I mean, you're doing well by doing good, so you're kind of a do-gooder. And your goal wasn't just to make money, but it was also to help the areas in which you concentrate your efforts. So, have all borrowers or a large percentage of them availed themselves of your offer? Some haven't. Why would people not avail themselves of your offer? And I guess I'll leave it at that for now. I have a follow-up question.
And we were surprised a little bit. When we first started buying loans, we thought the vast majority of families would want to stay in their homes and would want to do modifications. But as it's turned out, we end up doing modifications on maybe a third. And there's a good chunk of families who don't want the homes anymore. Maybe they've already moved out and they just take the cash, and we give them maybe $1,000 and they sign a deed and they're done. Most of the times it's because they've already vacated or they want to vacate. And then there's a percentage who don't do anything, and we end up having to foreclose. So that could be any number of reasons. It could be they're deceased, in which case we have no choice but to foreclose in most cases. They could have been so frustrated with their experiences with the prior lenders that when they get our letter, many people think it's too good to be true because the terms are too good, so they actually think it's a scam and they crumple it up and toss it in the trash. Now, it doesn't mean that we're going to give up. We'll send the letter multiple times, and then if we get in foreclosure, we'll continue to call, send letters, send people to their door to try to say, hey, we need a solution. But ultimately, we're no longer a charity. We can't let people stay for free, even if we were a nonprofit anymore. But we need to get to a resolution. And so whichever outcome they want, we'll give it to them. But if they don't respond, then we have to move forward with foreclosure or some kind of other adversarial proceedings. But we hope that acts as a trigger to provoke them to respond. And many a times it does.
Okay, so how would you were talking about a public relations aspect. How might you improve your PR so that people don't view you as they have been exposed to scams? It's common in these places. Mortgage scams were legion. So how do you differentiate yourself from the scammers and convince people to participate?
No, it's difficult. We've had some positive media, shows such as this help. But people have their guard up. Usually when they fall behind, especially they get a foreclosure notice against them, they're getting bombarded with letters from real estate agents trying to sell their home, attorneys who saying I can represent you, and any number of both savory and unsavory characters offering their services. And here comes our letter, which looks, in many cases people just say, your payment was $800, now it's $400. You owe $100, now you owe $50, and you haven't paid in 3 years. You owe $30,000. Give us $2,000. We forgive the difference. In some respects, we try to make it look. We look as official as possible. We always send them in priority mail, so it looks like we paid $5 to send it. So it should stand out. It's not just junk mail. But nevertheless, people do tell us sometimes, after we've started foreclosure, now they're calling and say, well, now I know you really own it. It is a public relations, a little bit of a challenge. We're marketing to people that we own their loans. They can't go somewhere else to get a resolution. We own it. So it's fairly captive. But even so, it's tough getting a connection. And sometimes, I can relate. When everything's going wrong, chances are these families aren't just behind on their mortgage. They could well be behind on their car payment. They could well be behind on their credit cards. They could well have their car, at risk of repo, and they could have payday loans. There's all kinds of business loans. There's all kinds of debt. So everybody's calling them. Everybody's sending them letters, and some people just shut down and don't do anything, and kind of hope it will get better. That's it's a frustrating position to be in. It's a very humbling position to be in. And it becomes very difficult to differentiate who is trying to help you and who is trying to, scam you. And it's an effort that's ongoing.
Undoubtedly. You paint a picture that people can relate to. If everybody's after you, you can't believe anybody. So you just don't do anything.
Exactly.
Does AHP, American Homeowner Preservation, operate in each of our 50 states? And are there state-by-state differences that are meaningful to AHP's model?
We buy loans in every state. And in fact, in September, we finally bought our first loan in Hawaii. So it really is something that's coast to coast, California to Maine. We bought loans in Puerto Rico. We bought loans in Alaska. And so it really is everywhere that we operate, that we can buy loans. Now, that all said, there's some concentrations of problem loans, and those are the states we end up working the most in. And the common thread amongst the concentrations is that they're in judicial foreclosure states. So a judicial foreclosure state is where the lender has to go through the court system in order to complete a foreclosure, and the alternative, or the many other states offer the non-judicial foreclosure, which is a process that's outside the court system, goes much faster. So to give you an example, in California, a lender can probably foreclose in about 6 months, sometimes even a little bit less. In New York right now, the average foreclosure is taking years, upwards of 2 years. And that is a huge contrast. So as a result, many of the lenders have kind of worked out their California loans. Either they've gone through this kind of fast foreclosure process, or they've made resolutions with the homeowners. But the biggest driver there is the fast foreclosure process. On the other hand, New York, New Jersey, Florida, Ohio, Indiana, Illinois, Florida, states such as this are judicial foreclosure states, and it can take a year, 2 years, or more to foreclose. And as a result, there's huge concentrations of problem loans in these judicial foreclosure states. And, you think of New York, you think of New York City, Manhattan, and we do own loans. We own loans in the Bronx and Brooklyn. But the big need is in places like Buffalo, Syracuse, Rochester. These cities have a huge number of loans, which dropped. The homes that are backing the loans dropped in value dramatically. And by and large, they haven't recovered, and that is where the greatest need is.
Okay, let's turn again to the investor part of AHP, because you do crowdfund, and crowdfund in the for real sense, as I like to call it, which is not just accredited investors, but anybody. There are certain restrictions on this, as you indicated. As a Regulation A+ entity, you can do this until you get to a certain size or issue a certain value in shares, and then you have to do the real registration under the Securities Act. So let's say I'm not an accredited investor. I don't actually think I am. Let's say I want to own. Let's say I say, okay, George, I'll give you $200. What do I get?
You get a membership interest in American Homeowner Preservation 2015 A+ LLC, which is the entity which owns the beneficial interest in all the assets that our company owns.
Okay, and as you alluded to earlier, I would get my share of the first 12% in money that comes in over and above expenses. Or is that close?
Correct. That is correct. So, if everything goes as planned, you would get, for a $200 investment, you get $2 a month. Well, basically 1% of your investment back each month.
And what if I don't want to do this anymore? How do I get out?
So we have best efforts liquidity, which basically means that if you needed the money back, you advise us, and we'll undertake our best efforts within 30 days to either liquidate the interest, which is to redeem it, to buy back ourselves, or to find another investor to purchase it. And we started offering that in one of our prior funds, and it kind of helped because there were some investors who said, hey, I like your returns, I'm investing this amount, but I'm also, let's say I buy apartment buildings, that's my primary investment, but I haven't found any good opportunities recently. So I have all this money sitting at the bank making little or nothing. So if I invest, I'd like to invest it with you and earn, up to 12%. But if I need it, if I find a great deal, I'll need it back. And what can we do in that situation? So that's what kind of led to this best efforts liquidity. And so far, we have had some requests, and we've always been able to meet them.
I should mention, as I alluded to earlier, that I met you at RealCap. That's RealCap, which is a conference that has been done 5 times, and now it's annual in the fall in Chicago, which brings together real estate crowdfunding professionals. And I can tell you it's a pretty enthusiastic group, and these people are deeply into it, and George has a key role in organizing it. So when it comes to crowdfunding and real estate, George both talks the talk and walks the walk. And they are really enjoyable conferences, I got to say. Kudos to you. So let's finish with something some wise person once said. And that person said, there will always be poor. And I think experience and history validates that point. There's always going to be folks struggling. AHP, your company, was birthed in the aftermath of a massive housing bubble, as we've discussed, from 100 to 50 in value of the underlying real estate. And we see that many loans on homes made during that period are underwater. The American Homeowners Preservation value proposition relies in part on lenders facing underwater collateral and making the best deal and selling it to AHP. I guess my question is, this business model of AHP, which has some reliance on the plummet in real estate values, would solid growth in the economy and higher wages diminish AHP's growth?
It probably would, although I think there's always going to be families in trouble, whether it's with their mortgage, their credit cards, student loans, whatever they have. So I think there's always going to be a need for us. And I actually think our expertise is not necessarily exclusive to mortgages. What we do is we offer solutions to debtors, to borrowers who owe money and can't afford to pay. And every type of loan, when it's not paid for some period of time, in many cases it's assigned to a collection agency or simply sold outright to a debt buyer such as ourselves. So I envision at one point, maybe if the need for the supply of delinquent mortgages drops, then AHP could maybe expand and buy student loans. There's tens or hundreds of millions of dollars of student loans that could well default over the next few years. Not good, but the good news is that maybe we can be there to purchase those at discounts and then try to work out solutions with those students. So I think that's really that's really the strategy that's somewhat unique to us. It's really simple. I tell them what it is. Anyone's welcome to copy it, but people don't. But we can, working out fast consensual solutions with people who have loans they can't afford is really the strategy, and that work applies to any type of debt. So I see growth continuing in just other types of debt in the event that the mortgage supply drops. That all said, the amount of mortgages that have been sold over the last 24 months has been huge, and it's gone in big billion-dollar or half-billion-dollar chunks to major hedge funds. And as those hedge funds work those out, they're finding these homes and these mortgages secured by lower value homes. It's really the last ones they work out. It doesn't make sense for them to devote resources to them when they have higher value loans to work out. So over time, those trickle down to us, and I expect that will continue for several more years. But over time, you're right, there's a high likelihood that the economy will, hopefully for everybody, will improve, wages will improve, home values will improve, and maybe our efforts can be, and our expertise can be applied to other types of debt.
Well, Jorge Newbery, founder and Chief Executive Officer of American Homeowner Preservation, thank you so much for this really interesting approach to solving a social problem, and doing it through crowdfunding and managing to return a solid return to investors. Thank you for being on this program.
Thank you, Chris, for having me.
You've been listening to Financial Poise Radio. Financial Poise Radio is a product of Financial Poise. See www.financialpoise.com. Financial Poise Radio is produced by Stephanie Strait. We thank you all for listening. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.financialpoise.com. Each week, Financial Poise Radio brings you news and education about finance, investing, business, and law. To see a short written summary of this episode, go to www.financialpoise.com. Financial Poise Radio is a production of Financial Poise Radio Productions, LLC.